David, thank you for having me back. And you're right, the numbers that have been reported have been very strong, particularly in the capital markets area. The advisory area, that's the mergers and acquisition fees that these companies earn, are generally up 2x over a year ago. You also saw strong ECM numbers led by the strong IPO market. And then on the trading side, equity trading was strong for all of these companies. FIC, of course, was down, but that was compared to a very strong third quarter last year. But across the board, the capital market numbers highlighted, as Wilfred said, about Morgan Stanley really putting up some incredible numbers.
Yeah, and James Gorman, when he joined us only about 30 or so minutes ago, Gerard also seemed to indicate he thinks they can keep it going. Maybe not at quite the same revenue growth rate they're seeing in capital markets, but he was pretty confident.
No, I think what's going to be interesting, and in response to a question I had on the earnings call talking about the future, we all know we've been in an incredible bull market since the spring of last year. And these companies have all captured that growth, which has obviously been good. But at some point, markets don't go to the sky, and we could have a down market at some point. But I think you're going to find Morgan Stanley and the other big players continue to capture market share because of the technological costs to remain competitive. And these companies have the wherewithal to make those investments.
Yeah. All right. Well, Wilf went through some of the revenue growth numbers for us. For some, it's not particularly impressive. And I come back to the idea of what's going to get the stocks higher. Is it going to be multiple expansion in some way, or, an appreciation for the consistency of their business?
It's an interesting question because what's happened is the start of the year, you might recall, the 10-year government bond yield was yielding about 91 basis points. So the trade into banks, and as you've seen from your work, that the bank stocks this year have outperformed the market, but it's been a macro trade. You want to own the banks because rates are going higher. I think this quarter is the inflection quarter where the handoff is going to go to the fundamentals for the group. And if the fourth quarter comes in better than the third quarter, now this is outside the investment banking activities, the traditional banking, Wilfred touched on the Bank America net interest income numbers. If this continues to grow for the group, which we think it will, because loan growth is finally turning positive, I think what you're going to see is the growth in the earnings will drive values higher in 2022 because of fundamentals, and it's not going to be driven by the macro trade as much as it has been in the past 12 months.
Yeah, Gerard, it's Morgan. That's exactly where I was going with you. There's been so much focus on the Wall Street piece of the puzzle where the banks are concerned, but what is the Main Street piece telling us in the results we've gotten so far? And perhaps just as importantly, the fact that we're seeing U.S. foreclosure starts increase 67% from a year ago. It's a huge percentage increase, as our Diana Olick points out, but coming off of severely depressed levels, given all of the moratoriums on foreclosures that we saw last year in the midst of the pandemic. But how real is the risk there as we do start to get to more of a normalization in the economy?
It's a good question. And, we all have fresh in our minds what happened in 0809 with the subprime housing crisis and the devastation it caused. But we have to remember a couple of things. One, to your point, the numbers are quite low. They're coming off of a low base. But two, housing prices are up dramatically. So should these banks have to foreclose, any losses will be minimal compared to what we went through in 0809. But more importantly, both JP Morgan Chase yesterday and then this morning Bank America, their consumer banking businesses are kicking out 30% return on equity numbers. That's very positive. So to us, I think what you're going to see is the economy comes back, as employment comes back, and the Delta and the COVID problems finally are in the rearview mirror sometime in 2022. These banks are positioned to really capture the growth for next year.